All right, let's dive right in. Today, we're going to pull back the curtain on how financial markets really work. We'll start by figuring out how investors put a price on something as simple as a promise, like a bond. And then we're going to flip the script completely and see how traders can actually make a profit when prices are falling. Sound good? Let's get to it.
So here's our game plan. First step, we'll get into how bonds are priced. Then, we'll talk about the real world stuff, yield, risk, and the market itself. After that, we're jumping into the pretty wild world of short selling, breaking down how a trade actually happens, and maybe most importantly, the big risks you absolutely need to know about.
Okay, section 1, pricing a bond. At its heart, a bond is just a loan. It's a promise that you'll be paid back in the future. But to understand what that promise is worth right now, today, we have to talk about one of the biggest ideas in all of finance, the time value of money. So let me just ask you this. If I gave you an ironclad guarantee that I'd hand you $1,000 exactly 1 year from today, what would you pay me for that promise right now? It's not $1,000, is it? Of course not. Because a dollar in your hand today is way more powerful. You could invest it, you could earn interest on it, heck, you could just enjoy having it. And that simple idea, that intuition, that's the bedrock of modern finance. And there's a name for this, of course. It's called present value. It's what that future money is worth to us right here, right now. So how do we figure that out? Well, we use something called a discount rate. You can almost think of it as interest in reverse, to pull that future cash back to the present day. And you know what? The math is actually pretty simple. To get the present value, you just take that future value, our $1,000, and you divide it by 1 plus the interest rate. So if we use the example from our source material with a 4% interest rate, that future grand is only worth about $961 today. See, it's that straightforward. Now let's build on that. This visual here does a perfect job of showing how we apply this to a bond. See, a bond isn't just one future payment. It's a whole stream of them. You've got all those smaller bars. Those are the regular interest payments, or coupons. And then that one giant bar at the end, that's you getting your original loan back. The price of the bond? It's just the sum of all those bars, with each one individually discounted back to what it's worth today. Okay, so here's where it gets really interesting. What happens if you're holding a bond that pays you 4.5%, but brand new bonds being issued today are paying 5%? Well, all of a sudden, your bond looks a little less attractive, doesn't it? So for anyone to buy it from you, you'd have to sell it for a little less than its face value, at a discount. And that's what we call trading below par. All right, now we're going to move on from the pure math and get into the messy reality of the market, where things like yield, risk, and all the different players come into play. This graph shows you the absolute golden rule of the bond world. Just think of price and yield like they're on a seesaw. When one goes up, the other has to come down. It's a constant inverse relationship. So when a bond's price falls in the market, the effective return, or the yield you get for buying it at that new, lower price, goes up. But, of course, not all promises are created equal. There's always the chance the borrower might not be able to pay you back. That's what we call credit risk. Governments, well, they're seen as super safe because, they can always just raise taxes or print more money to pay their debts. A corporation can't do that, which makes their bonds riskier. And that's why they have to offer a higher yield. They're basically paying you extra for taking on that extra risk. So who are all these people doing the trading? Well, you've basically got two teams. On one side, there's the buy side. Think pension funds, big investment managers. Their job is to grow money for their clients. And on the other side, you've got the sell side. These are the investment banks, and they're like the market's matchmakers, connecting all the buyers and sellers and making the trades happen. So how does that sell side make its money? Well, this quote from the source material gives us the perfect analogy. Just picture one of those currency exchange kiosks at the airport. They'll buy euros from you at one price and then turn around and sell them to the next person for a little bit more. That tiny difference between the buying price and the selling price is called the bid-ask spread, and that's their profit. It works the exact same way with stocks and bonds. Okay, now it's time for a major plot twist. So far, we've only talked about making money when prices go up. But what if you could profit when a price goes down? Well, you can. Welcome to the fascinating, and often controversial, world of short selling. So what exactly is short selling? It's simple, really. Just take everything you know about investing, buy low, sell high, and flip it on its head. Short selling is all about sell high, then buy low. You are literally betting that the price of something is going to fall. I know, it sounds a little weird, right?
how can you sell something that you don't even own in the first place? Well, let's break down the mechanics step by step. It's actually a pretty clever process. Here we go. Step 1. You borrow shares of a stock from someone who owns them. Step 2. You immediately sell those borrowed shares on the open market. Step 3. You wait. This is where your bet plays out. Step 4. If you were right and the price drops, you buy the same number of shares back, but now at that new, lower price. And finally, step 5. You return the shares to the person you borrowed them from, and you get to keep the difference as your profit, after paying any fees. Okay, let's make this real with an example straight from our source material. So we've got an analyst who is absolutely convinced that a company, M&Q stock, is way overvalued at $80 a share. So they decide to go for it and short 500,000 shares. Let's crunch the numbers and see what happens.
So the first move is made. They borrow those 500,000 shares and sell them on the market for $79.20 a pop. That brings in a whopping $39.6 million in cash. That cash is now just sitting in their account waiting for the next step.
Now we fast forward 6 months, and guess what? The analyst's bet was right on the money. The stock took a nosedive. So now it's time to close out the trade. They buy back the 500,000 shares, but this time they only have to pay $72.33 for each one. The total cost? Just over $36 million.
But wait, there's a catch. It's not free to borrow all those shares. There's a financing cost. And for this trade, over 6 months, that cost came out to nearly $1 million. That's a serious expense you have to factor in.
And now for the moment of truth. You take the money from the initial sale, you subtract the cost of buying the shares back, and you subtract that big financing fee. The final profit comes out to a massive $2.4 million. That, right there, is the power of a successful short trade.
Now, a profit like that looks amazing, but do not be fooled. Short selling is like walking a tightrope with no safety net. It is an extremely high-stakes game with some very unique and dangerous risks.
And this quote right here says it all. Think about it. When you buy a stock, the absolute most you can lose is the money you invested, right? If it goes to zero, you lose 100%. But when you're shorting a stock, if you're wrong and the price goes up instead of down, there is literally no ceiling on how high it can go, which means your potential losses are infinite. It's a truly terrifying possibility.
And that brings us to one last question to think about. Short sellers often get a bad rap. They're seen as these gloomy pessimists rooting for failure. But as our source material points out, they also play a vital role. They act as a check on irrational hype and prevent bubbles from getting out of control. So I'll just leave you with this. Is betting against a company a necessary, vital function for a healthy market, or is it a purely destructive force? It's a debate that's still very much alive.